S&P 500 closed at 7,502.54, up 0.87%.
Right.
The Nasdaq surged 1.19% to close at 25,421.35. The Dow Jones Industrial Average added 345 points, or 0.66%, closing at 52,553.51.
Huge day.
And the 10-year Treasury yield climbed 6.3 basis points to close at 4.74%.
Yeah, that's the big one.
Right, so those are the closing numbers. And this is your end-of-day deep dive.
Yep.
Our mission for you today is simple, but given the absolute chaos on the screens, it is critical. We're delivering a fast, comprehensive recap of the day's massive stock market swings and, well, the really heavy economic data dumps we got.
Because there was a lot to process today.
Exactly. The market just threw this mountain of conflicting signals at you today. And if you have money in the market right now, you need the full landscape of how these moving pieces connect before tomorrow's opening bell. We are prioritizing breadth over depth here, just to get you everything you need to know.
It was really a day defined by violent divergence. I mean, we saw asset classes, sectors, and even, the most highly correlated tech monopolies on the planet completely detached from one another.
Yeah, the Mag 7 was all over the place.
Exactly. And it all came down to one core question, right? Who is dealing in future promises and who is generating actual cash flow today?
Right. And we have to start with the biggest single stock driver of the major indexes today, which is that Mag 7 earnings divide.
Big tech split reality.
Yeah. And if you're holding these names, the contrast is honestly jarring. Let's start with the massive winner. Amazon absolutely skyrocketed today.
Up over 15%.
Yeah, closing around $270.28.
Mm-hmm.
And the baseline catalyst there is that their second quarter revenue crossed the $200 billion mark for the first time in company history.
Which is just a staggering number.
It really is. That's a 20% year-over-year jump. But,
yeah.
The real story, the metric that had trading desks frantically rewriting their models this morning is AWS.
Oh, absolutely.
Amazon Web Services grew 37% to $42.2 billion. That completely blew past Wall Street's consensus.
And we really need to look at how they did that, because a 37% growth rate at a $40 billion plus quarterly run rate?
It almost breaks the map.
Right. It's almost difficult to comprehend mathematically at that scale. What's fascinating here is that AWS is proving that their massive capital investments in artificial intelligence over the last 2 years, they're actually yielding immediate tangible monetization.
So they're actually making the money back already.
Yes. For the past year, Wall Street has been terrified, frankly, that all this AI spending was just some experimental phase for enterprise clients.
Like a beta test.
Exactly. Amazon just proved that phase is over.
Yeah.
Enterprise clients aren't just running beta tests on Amazon's cloud anymore. They are deploying AI tools at a commercial scale right now.
Wow.
They are paying top dollar for the compute power, the raw server access, and the data architecture required to actually run these large language models in their daily operations.
Okay, let me use an analogy here because I look at this entire AI boom like the ultimate 1849 gold rush.
I like that, yeah.
Right now, Amazon and Microsoft and Google, they are selling the shovels. They own the cloud computing infrastructure.
The picks and the shovels.
Right. Every company that wants to mine for AI gold has to buy server space from them. The miners are lining up, and Amazon is ringing the register right this second.
Spot on.
But then you look at Apple, and it's a completely different universe today. Apple plunged roughly 9.6%, closing around $312.60.
A huge hit.
Massive. And here's why this is so confusing if you just, casually read the headline. They actually beat their Q2 profit estimates.
Yeah, iPhone sales were up 22%.
Right, but the stock still tanked.
Because the market doesn't pay for the past, right? It pays for the future. And Apple's forward guidance fell significantly short.
Right, and to go back to my analogy, Apple's essentially a company that wants to build the best, most premium automated mining equipment in the world. They want to sell the consumer device.
The consumer entry point.
Yes, but they're stuck at the factory, waiting for the steel to arrive because the price of raw materials just doubled.
That's exactly it.
They can't get their hands on the AI components they need cheaply enough to make their rollout profitable. So, walk me through the mechanics here. Why is Apple suddenly struggling with hardware margins when, supply chain dominance is basically their entire corporate identity?
It comes down to the physical reality of how on-device AI actually works. Apple is facing a severe bottleneck in a very specific type of hardware, high bandwidth memory or HBM chips.
Okay, HBM chips.
Right. To run complex AI models locally on an iPhone, rather than relying on a cloud server somewhere, the device needs massive amounts of highly efficient memory.
Which they apparently don't have enough of.
Well, the problem is manufacturing high bandwidth memory is incredibly difficult. You are literally stacking memory chips on top of each other and connecting them with microscopic vertical wires. The global capacity to produce these chips is severely constrained right now. Because supply is tight and demand from literally every tech company on Earth is off the charts, the cost of these memory chips is just skyrocketing.
So it's fundamentally a cost of goods sold issue.
Exactly. Apple has customary gross margins of over 40% on their hardware, and that margin is sacred to their valuation.
Wall Street demands that 40%.
They demand it. But right now, the supply chain is eating directly into that profit pool. Investors looked at that forward guidance and realized that, yes, Apple has 1 billion users waiting for AI on their phones, but the physical cost to build that hardware is surging.
Which perfectly explains why the rest of the shovel sellers saw a huge rebound today. Microsoft added 3% after their Azure cloud division topped $100 billion in annual revenue.
Huge milestone.
Yeah. And Alphabet jumped over 5% on the back of Google Cloud revenue, surging an insane 82%.
Unbelievable growth.
And even Meta, right, which took an absolute beating earlier in the week over their massive capital expenditure plans, they stabilized and rose 1.76%.
And that stabilization is really crucial to understand here. Earlier in the week, there was a very real fear among institutional investors that these hyperscalers were just pouring tens of billions of dollars into data centers and GPUs without a clear path to getting that money back.
Or the ROI question.
Yeah, exactly. But Amazon's AWS print, combined with Google Cloud's surge, it provided the ultimate proof of concept. The revenue is flowing to the infrastructure providers today.
But here is where we have to pivot. Because while the tech billionaires are counting their cloud revenue, we have to look at what happens when we look at the people actually clicking the buy buttons.
The consumer.
The real economy. If you are listening to this, you're not just an investor. You're a consumer. And the data we got today on inflation and incomes paints a deeply concerning picture.
It was rough.
Yeah. We got the personal consumption expenditures data for June today, the PCE. As we know, this is the Federal Reserve's preferred inflation gauge.
The one they watch closest.
Right. Headline PCE rose 3.7% year over year. That is down from 4.1% in May. On paper, that sounds like a win. We're moving in the right direction.
Sure, on paper.
But core PCE, which strips out food and energy, rose 3.3% year over year. Okay, let's unpack this. Why is that core number such a problem?
Because that 3.3% core number is the sticky, stubborn reality of this economy. The only reason the headline number came down from 4.1% is because of a massive 48.1% drop in gasoline and other energy goods purchases during the month.
Which is incredibly volatile.
Highly volatile. I mean, gas prices swing wildly. But when you look underneath the hood at core PCE, consumer spending on services is still pushing relentlessly upward. We are talking about the unavoidable costs of living, things like healthcare, insurance, and vehicle maintenance.
Things you can't just stop buying.
Exactly. You can't just opt out of your car insurance.
Which brings us to the most alarming part of the data dump for you as a retail investor, because it shows exactly how stretched the American wallet is right now. Nominal consumer spending increased 0.3% for the month, or about $65.2 billion.
So people are spending more.
Right. The headline is, people are spending more money, but personal income only rose 0.2%. Because spending is outrunning income, the personal savings rate just dropped to a near record low of 2.7%.
That's the red flag.
Right. Let's pause there. I want to use a different analogy here. For a while, we've been saying that consumers treading water.
Right.
But looking at this data, treading water implies you're at least staying in the same spot. This feels more like being on a treadmill where someone else has the remote and they keep secretly upping the incline.
The treadmill is a much better way to look at it, actually, because it highlights the illusion of economic growth we are seeing in the data. You mentioned nominal spending was up 0.3%.
Yeah.
That's just the raw dollar amount leaving checking accounts. But if you look at the real PCE volume, the actual physical amount of goods and services being consumed, it was essentially flat. Specifically, real consumption was up just 0.4%.
Wait, explain the difference between those two numbers for a second. If I am spending more money, shouldn't I be getting more stuff?
Normally, yes. But in a sticky inflationary environment like this, no. That gap between nominal spending and real consumption means consumers aren't buying more things.
They're just paying more for the same stuff.
Exactly. They aren't going on an extra vacation, they aren't upgrading their cars, and they aren't buying more groceries. They are simply paying higher prices to maintain their exact same lifestyle.
Just to run in place.
They are running faster on the treadmill just to stay in the exact same spot. And because their income only rose 0.2%, they are funding the difference out of their savings accounts.
Which explains the 2.7% savings rate.
Exactly. That is why that savings rate plummeted. The average household's cash flow is being pushed to the absolute limit.
And it gets worse when you look at the Q2 employment cost index that dropped today. Labor costs grew 0.9% quarter over quarter and 3.4% year over year.
Right.
If you're an employee, you might think, great, wages are up 3.4%. But get this, benefit costs grew 3.8% year over year. They are completely outpacing actual wage growth, which was only 3.2%.
It's a huge problem.
When you adjust for inflation, real wages, constant dollar wages, they actually decreased 0.3% over the year.
It is the ultimate lose-lose dynamic in the labor market right now. Employers are genuinely paying more for labor. Their margins are getting squeezed by a 3.8% rise in benefit costs, largely driven by soaring healthcare premiums.
But the workers aren't feeling richer.
No, the worker doesn't see a dime of that increase in their checking account. It is entirely eaten up before the paycheck even hits. So the employee feels poorer because their take-home pay is actually shrinking in real terms, down 0.3%.
Okay, so if I am a retail investor looking at this, I see a market where consumer spending is technically up, but real wages are down, savings are basically gone, and the bulk of wage gains are being vaporized by healthcare premiums.
It's a toxic mix.
It is, and this brings us directly to the Federal Reserve. Because this exact dynamic, sticky inflation combined with the squeezed consumer is why the Fed is completely paralyzed.
Completely stuck.
Let's get into the central bank action we saw yesterday and the violent bond market reaction we saw today. Yesterday, the FOMC, led by Chairman Kevin Warsh, made a highly controversial decision to maintain the benchmark rate at a range of 3.50% to 3.75%.
And it was a very fractured room.
Yeah, we had three vocal dissenters, Neel Kashkari, Beth Hammack, and Lori Logan. They pushed hard for an immediate rate hike. Their argument was that 3.7% headline inflation is still entirely too far above the 2% mandate to justify sitting on their hands.
And if you watched Warsh's press conference, he was walking an incredibly fine line. He essentially suggested that the recent organic rise in bond yields might act as a substitute for further Fed rate hikes.
Wait, basically saying, hey, we don't need to hike rates because the bond market is tightening financial conditions for us.
Precisely. He was floating the idea that the Fed can just let the bond market do their dirty work. If borrowing costs go up naturally, it slows down the economy without the Fed having to officially pull the trigger on another hike.
Well, the bond market heard him loud and clear, and they fired a massive warning shot today. We saw what analysts are calling a twist in the yield curve. Short-term rates stayed relatively anchored. The 3-month bill closed at 3.78%, and the 2-year note ticked up slightly to 4.30%.
But a long end.
Yeah, the long end of the curve just absolutely exploded. The 10-year Treasury yield hit 4.74%, its highest level since January 2025. And the 30-year bond spiked to 5.27%, the highest we have seen since 2007.
It was a violent move.
Wait, hold on. Let's pause and debate this for a second, because it doesn't make intuitive sense to me.
Okay.
Usually when the Fed holds rates steady and signals they might be done hiking, the bond market relaxes. Yield should go down. Walk me through why the Fed doing absolutely nothing made 30-year yields explode to a 19-year high.
If we connect this to the bigger picture, it goes back to the concept of a term premium and what bond traders call a bear steepener.
Okay, a bear steepener.
Right. When you buy a 30-year Treasury bond, you are locking your money up for 3 decades. You demand a yield that compensates you for the risk of inflation eating away at the purchasing power of your money over those 30 years.
Makes sense.
So, when the bond market heard Kevin Warsh say the Fed might pause despite inflation still sitting at 3.7%, the bond market immediately decided that the Fed does not have the stomach to actually get inflation under control.
They lost faith in the Fed's inflation fight.
Exactly. The bond market essentially said, if you aren't going to hike rates today to kill inflation, then inflation is going to run structurally higher for the next decade.
Wow.
And if inflation is going to be higher for longer, investors are going to demand a much higher yield to lock their money away for 10 or 30 years.
So short-term rates stayed anchored because the Fed held their benchmark rate steady.
Right.
But long-term rates surged because inflation expectations for the future just completely unanchored.
Yes. The bond market is in open revolt against the Fed's inaction right now.
A bear steepening. Okay, so for you listening to this, wondering how Wall Street bond math affects your life on Main Street, let's look at housing. Keep it brief. What does a 5.27% 30-year Treasury yield actually do to the U.S. housing market? Keep in mind, average 30-year fixed mortgage rates are already sitting at 6.53%.
It effectively paralyzes the entire residential real estate sector. I mean, mortgage rates track the 10-year and 30-year Treasury yields. When those Treasury yields spike to 2007 levels, it ensures mortgage rates remain suffocatingly high.
So nobody moves.
Right.
Yeah.
This creates a lock-in effect. Current owners who have a 3% or 4% mortgage from a few years ago, they absolutely refuse to sell because taking on a new 7% mortgage would destroy their monthly budget.
So inventory just plummets.
Inventory plummets. Meanwhile, new buyers are priced entirely out of the equation because the cost of capital is too high. The housing market just freezes solid.
And the really terrifying part is that this spike in long-term bond yields doesn't happen in a vacuum. It is directly tied to those inflation fears. Which brings us to another massive driver today, geopolitics and the energy sector.
Yeah, this is where things get really tense.
Right, because if bond traders are worried about inflation, the absolute worst thing that can happen is a shock to energy prices. Yeah. And today, WTI crude oil jumped 7% to $85 a barrel. Brent crude is sitting near $87.66.
A massive single-day move for oil.
And this is entirely geopolitical.
Right.
We saw a missile strike on a U.S. base in Jordan today, followed by escalating threats of military retaliation against Iran.
And we have to be really clear about how an oil shock fundamentally breaks the Federal Reserve's models.
Because it bleeds into everything.
Everything. Energy prices bleed into the cost of literally every single good and service in the entire global economy. It costs money to fuel the ships, the trucks, and the planes that deliver products to the consumer.
Yeah.
If geopolitical tensions escalate and WTI crude sustains a run back toward $90 or $100 a barrel, that sticky 3.7% inflation print we talked about earlier, that is going to look like the good old days.
Oh.
Yeah. Inflation will reaccelerate rapidly, which forces the Fed to hike rates, which drives bond yields even higher, which crashes the economy. It is a vicious feedback loop.
But here's where it gets really interesting. And honestly, it gets incredibly counterintuitive. Let's look at the actual energy companies.
Yeah.
You would logically think that with oil prices surging 7% today and energy companies raking in cash, their stocks would be soaring.
You would think that, yeah.
But they aren't. ExxonMobil fell 2.15% today, closing at $153.60. And I want to emphasize how wild this is. They reported massive second quarter earnings of $14.5 billion. That is their highest quarterly profit in 4 years.
A monstrous quarter.
They returned $9.4 billion to shareholders in dividends and buybacks. But the stock drops. And Chevron had a very similar day. Their stock fell 1.51% to $154 in Q2 earnings. Right. They grew their Permian Basin oil production by 20%, and they achieved $1.5 billion in acquisition synergies from buying Hess. They even had $3 billion in structural cost reductions. So record profits, massive buybacks, surging underlying commodity prices, and the stocks drop. Explain this irony to me. How do they lose on a day like today?
It is the perfect example of how public markets operate. Missing Wall Street's forward estimates matters infinitely more than looking backward at a record quarterly profit.
Okay, so what did they miss?
For Exxon, the issue was a very specific operational failure. Limited refining capacity. In the oil business, you have upstream operations, pulling the crude oil out of the ground, and downstream operations, refining that crude into usable products like gasoline, diesel, and jet fuel.
Right.
Exxon has become incredibly efficient at pulling oil out of the ground, but they hit a severe bottleneck in their downstream refining capacity. It simply does not matter how much crude oil you extract if your refineries can't process it efficiently enough to capture the full profit margin on the finished product.
So they essentially bottlenecked themselves.
Exactly. Because they couldn't refine it fast enough, they missed Wall Street's consensus estimate of $3.60 per share. The market looked right past that impressive $14.5 billion absolute number, saw the refining constraints limiting their future upside in a high oil price environment, and punished the stock.
And what about Chevron?
Chevron suffered largely from guilt by association and a broader macroeconomic rotation out of certain value names today. Institutional investors are looking at the future cost curve of maintaining these massive operations, not the past cash flow.
Okay, so let's track the logic here. We have sticky inflation, we have rising oil prices, we have escalating military tensions in the Middle East, and we have an uncertain Federal Reserve. Historically, for the last 5,000 years, that specific combination of chaos is the exact recipe for investors to panic buy gold.
It's the classic playbook.
Right. Gold is the ultimate inflation hedge and safe haven asset. But today brought a surprising twist in the commodities market. Spot gold actually fell 0.5% today to $4,045.59 an ounce. Why did the ultimate safe haven drop on a day when geopolitical risk went through the roof?
Because gold is currently caught in a massive tug of war between strong macroeconomic headwinds and immense structural tailwinds. And today, the headwinds simply exerted more pressure in the paper trading markets.
Let's break those headwinds down. The primary one has to be those 19-year highs in long-term treasury yields we were just discussing.
Exactly. That is the fundamental headwind. If you are an institutional investor and you can get a guaranteed risk-free 5.27% return on a 30-year U.S. government bond, the opportunity cost of holding physical gold becomes extraordinarily high.
Because gold pays zero yield.
Right. It pays zero yield. It pays zero dividends. It just sits in a vault. When real interest rates, meaning interest rates adjusted for inflation, when they rise rapidly like they did today, capital traditionally flows out of gold and into government bonds.
That makes sense for the paper markets in New York and London. But you mentioned structural tailwinds providing a floor for the price. Who is buying gold right now if Western institutions are selling?
Central banks, primarily in the East. Central bank buying is accelerating at a pace we haven't seen in modern history. In the second quarter alone, global central banks bought 289 tons of gold.
289 tons in a quarter.
Yes, that is up 62% year over year. And according to recent surveys, almost half of global reserve managers plan to increase their gold holdings even further over the next 12 months.
Why the sudden rush?
They are aggressively diversifying their national reserves away from the U.S. dollar due to geopolitical fracturing. They want an asset that cannot be sanctioned or frozen by the Western financial system.
And then there is the fascinating retail situation in India. This is one of my favorite data points from today. India is historically one of the largest consumers of physical gold in the world.
Oh, absolutely. It's deeply cultural.
Right. But recently, the Indian government slapped a new 15% import duty on gold. When you add in local state taxes, there is now an 18% premium just to legally import gold into the country.
Which completely distorts the market.
Yeah, exactly. As a result, the official Q2 demand in India fell 6% on paper. But that doesn't mean the Indian population suddenly stopped buying gold. It means over 100 tons of demand simply vanished from the official ledgers and shifted instantly into unofficial gray market trading channels.
It just went underground.
I mean, just think about the logistics of this.
Yeah.
We are talking about 100 tons of physical gold being smuggled across borders to avoid an 18% tax. You can't just hide 100 tons of metal in a standard suitcase.
Definitely not.
Seizures of smuggled gold at the borders have doubled recently. The demand is absolutely still there. It just went underground.
And that gray market demand is exactly why some of the smartest analysts on Wall Street are completely ignoring today's price drop. Institutions like JP Morgan are looking right past the short-term pressure from U.S. Treasury yields.
Right. They have massive targets.
They are actively setting long-term price targets for Q4 of 2026 at $6,000 an ounce.
That's a massive premium over today's $4,000 price. How do they justify that if yields are at 19-year highs?
Their thesis is that the current yield-driven dip is purely a localized Western phenomenon. The paper market in New York is selling gold futures because of Treasury yields.
But the East is buying.
Exactly. That selling is actively masking immense structural physical demand from Asian markets and global central banks. The physical buyers in the East are happily absorbing every single ounce the West sells at these prices. Eventually, physical supply and demand will overwhelm the paper trading algorithms.
It's an incredible disconnect between the computer screens in New York and the physical reality in places like Mumbai and Beijing.
Yeah.
All right, we have covered the massive macro themes: the tech divide, the consumer squeeze, the Fed, oil, and gold. Now, I want to inject some speed into the end of this deep dive.
Let's do it.
Let's hit the day's other massive single-stock movers across healthcare, energy, and industrials. We're going to rapid fire through these, but I just want the numbers. I want to know the mechanisms behind why these specific stocks violently repriced today.
I'm ready. Let's break them down.
First up, the biotech sector was on fire today, but moving violently in both directions. Let's start with a huge winner, Replimune, ticker REPL. Surged a spectacular 133% today. How does a company more than double its market cap in a single trading session?
It is a classic biotech binary event. Replimune received a highly positive FDA advisory panel opinion for their RP1 melanoma treatment.
Okay, so they got the panel vote.
Yes. To understand this, you have to know how the FDA approval process works. Before the FDA makes a final decision on a new drug, they convene an independent panel of medical experts to review the clinical trial data.
Right.
In the biotech world, securing a positive vote from that advisory panel is the closest thing you can get to a guaranteed green light for commercialization.
So it de-risks the whole company.
For an early-stage biotech company, that panel vote takes a future revenue stream from highly speculative to highly probable. The stock reprices instantly because the risk of total failure was just removed from the equation.
But on the exact opposite side of the healthcare spectrum, we have pharmaceutical giant Novo Nordisk, ticker NVO. They plunged 10% today. Novo is a massive multi-billion-dollar company. It takes a monumental shift in value to move a company of that size 10% in a single session.
Novo suffered a very high-profile failure in a phase 3 clinical trial for a new cardiac drug.
And phase 3 is the big one.
It's the final hurdle. Novo Nordisk has been priced for absolute perfection over the last year, largely due to their utter dominance in the GLP-1 weight loss drug market with Ozempic and Wegovy.
Right.
But their valuation assumes they will be able to expand that success into other massive chronic diseases, like cardiovascular health. Phase 3 is the final, most expensive, and most critical stage of clinical testing before FDA submission.
So when it fails?
When a major pipeline asset fails in Phase 3, the market brutally and instantly recalculates the terminal value of the company's entire future growth portfolio. A 10% drop on a mega-cap pharma stock reflects billions of dollars of projected future earnings evaporating overnight.
Let's move over to alternative energy. Bloom Energy, ticker BE, jumped 26.49% today. What's the catalyst there?
Two things happened simultaneously. They delivered remarkably strong Q2 financial results, and they coupled that with a major analyst upgrade from Mizuho.
But why are they surging right now?
Well, the why is the interesting part. It ties directly back to our first topic on AI infrastructure. The market is incredibly nervous about the sheer amount of electricity required to power these massive new AI data centers. The traditional power grid in many parts of the country literally cannot handle the load.
And Bloom fixes that.
Bloom Energy manufactures solid oxide fuel cells that generate electricity on-site. They're increasingly being viewed not just as a green energy play, but as a critical off-grid power solution for tech companies desperate to build data centers without waiting years for utility grid upgrades.
Wow, so they are a secondary shovel seller in the AI gold rush.
Exactly.
All right, back to the biotech carnage. Alnylam Pharmaceuticals, ticker ALNY, absolutely crashed today, down 28.31%.
Yeah. Alnylam is a painful lesson in forward guidance. They slashed their 2026 product revenue guidance today.
Ouch.
Yeah. In high-growth sectors like biotech or tech, your current valuation is entirely dependent on future promises. Investors are paying a premium today for the cash you promised to generate 3 years from now.
So the second they admit a delay,
The second management cuts that future promise, the market aggressively slashes your valuation. They lost nearly a third of their market cap in a matter of hours, simply because the 2026 outlook got slightly darker.
brutal. Let's move to materials and industrials. Lindt PLT, ticker LIN, dropped 6.27%. That is its worst single trading day since the COVID crash in 2020. Why does this specific company matter to the broader economy?
Linde is one of the world's largest industrial gas companies. They supply the essential gases like oxygen, nitrogen, and argon that are required for almost all heavy manufacturing, chemical processing, and electronics production globally.
So they're a bellwether.
They're what we call an economic bellwether. If Linde is slowing down, it means global manufacturing is slowing down. Today, they cited rising industrial input costs squeezing their operating margins.
Which ties right back to inflation.
Exactly. When a company of Linde's scale and reach flags severe input cost inflation, it validates the exact inflationary fears that drove the 30-year Treasury yield up to 5.27% today.
Medical devices saw some love today, though. Dexcom, ticker DXCM, gained 11.02%.
Dexcom delivered a perfectly clean beat-and-raise quarter. They beat both Q2 revenue and earnings estimates, and they raised their full-year outlook.
What's the mechanism there?
The mechanism here is the resilience of their specific product. Dexcom makes continuous glucose monitors for diabetic patients. This is non-discretionary healthcare spending.
Right, you can't just skip it.
Even if a consumer's savings rate drops to 2.7% and their credit cards are maxed out, they still have to manage their diabetes. Dexcom is highly insulated from the macroeconomic slowdown we discussed earlier.
In the agriculture sector, Corteva, ticker CTVA, fell 10.17%. And the weird part here is that they actually raised their 2026 outlook earlier in the week. How do you fall 10% on good news?
Corteva is a prime example of a stock becoming a casualty of broader market positioning. In a highly volatile market tape like we saw today, hedge funds and institutional algorithms will often liquidate their winning positions.
Just to get cash.
Yeah, they do this to cover margin calls on their losing trades or simply to de-risk their overall portfolios ahead of an uncertain weekend. Corteva has strong fundamentals, but it was caught in the crossfire of massive institutional portfolio rebalancing. Sometimes stocks are sold simply because they are highly liquid and the fund manager needs cash immediately.
And finally, rounding out the tech and semiconductor space, Micron Technology, ticker MU, dropped 3.72%.
This ties the entire day perfectly back to our first segment on Apple. Micron is one of the premier manufacturers of memory chips.
The HBM chips we talked about.
Exactly. The market is increasingly concerned about the rising cost curve of memory manufacturing. The physical difficulty of building high bandwidth memory is weighing heavily on the sector.
And what happens if the costs stay this high?
Investors are worried that if memory costs rise too high, end users like Apple will either balk at the pricing, reducing order volumes, or they will accept the pricing but see their own hardware margins collapse. That fear dragged down the entire semiconductor hardware space today.
And that perfectly connects the dots from the tech giants down through the supply chain. That wraps the deep dive on today's action. Let's briefly look ahead to what is coming. Tomorrow's calendar is heavy.
Very heavy.
The markets are going to be laser focused on the upcoming weekly jobless claims, and we get more regional inflation data next week. Everyone on Wall Street is trying to find out if the American consumer can actually hold up under this immense pressure, or if the cracks we saw in today's PCE data are going to widen.
And this raises an important question, something I think every investor needs to actively mull over tonight as they look at their portfolios.
Just say.
Well, we just spent time discussing the personal savings rate plummeting to 2.7%. We know credit card reliance is climbing rapidly as consumers try to fund the gap between flat real wages and rising service costs. Meanwhile, the 30-year Treasury yield just hit a level we haven't seen since the onset of the Great Financial Crisis in 2007.
Which keeps borrowing costs for mortgages and auto loans exceptionally high.
Exceptionally punitive. The math is becoming incredibly tight for the average household. The question is the U.S. consumer about to hit a brick wall and trigger a severe recession before Kevin Warsh's Federal Reserve is finally forced to capitulate, abandon their inflation fight, and cut interest rates?
It is the multi-trillion-dollar question, and honestly, the X-ray of this market is looking blurrier by the day. The cross-currents are massive right now. That is it for today's deep dive into the markets. Make sure you hit follow on the show so you don't miss our daily market coverage. We'll be back tomorrow to see if the market finds some much-needed clarity or if the muddy waters just get deeper.